Once again, a very good morning, everyone, and a hearty welcome to today's webinar. Let me begin by thanking you all for taking the time and interest to join us today on our discussion on the UAE corporate tax. My name is Jyotika, and I've been working with Kothari Auditors and Accountants in the Tax and Compliance Department. Before we proceed to the session, I'd like to give a brief introduction of our company, Kothari Auditors and Accountants, better known as KAA. Established in the year 1992, KAA has been proudly serving in the professional field for more than 30 years, providing management and financial consulting services, including audit, accounting, tax, and company registration services. KAA operates in two offices located in Khalid bin Walid Street in the Emirate of Dubai and Bank Street, Rola in the Emirate of Sharjah. Our associate office, Global Business Services DMCC, which was established in the year 2010 and located in Jumeirah Lake Towers, Dubai, specializes in the formation of global entities, trusts, and foundations in the UAE and worldwide. As you are all aware, we are nearing the much-awaited implementation of the corporate tax in the UAE, and it's time to gear up our businesses to ensure that we are updated of the recent developments in the corporate tax legislation and prepare for its smooth implementation. As always, the KAA-GBS Group is committed to ensure our clients are updated of the latest clarifications issued by the authority, and we therefore have you all here at yet another webinar on the UAE Corporate Tax series. With this note, I'd like to introduce our speakers for the day. It's my privilege to introduce before you Mr. Vipul Kothari, the founder and head of KAA and GBS. He has the distinction of passing the Chartered Accountancy at the age of 21 from the Institute of Chartered Accountants of India, and went on to receive gold medals from BK School of Business Management in MBA Finance. We also have with us Mr. Prasad Bhonde, the Director of Audit and Tax. He is Company Secretary in addition to many more professional qualifications and has over 20 years of progressive experience in the professional field. We also have with us Mr. Kapil Sheth, the Manager, Tax and Corporate Compliances. He is a Chartered Accountant and has over 11 years of experience in the field of international taxation and corporate tax in India and Oman. Before I hand the session over to the speakers, please note that the session is being recorded and all the participants are muted. In case you have any questions, please raise them in the chat box and we shall answer them at the end of the session. So without delaying any further, let's move on to the session. Over to you, sir.
Thank you, Jyotika, for the kind words of introduction. Good morning. Welcome everyone to this session on corporate tax in UAE. This is a very important topic, which all of you are aware that time is now coming very close for the implementation of the corporate tax in UAE. And it's a path-breaking regulation which is being introduced in UAE. As you all are aware, UAE had been highly economy which was not regulated so much, and where we did not have too many regulations for the corporate compliances in place. However, the journey towards compliances in UAE began, I would say, probably around 6-7 years back when UAE signed the OECD BEPS action plan and agreed to implementation of various action plans of OECD with respect to tax transparency and fairness across the global jurisdictions. And it accepted the fact that UAE also has to bring in various compliances and regulations which are in line with the international best practices. It all began with signing of various tax information exchange agreements many years back. And thereafter, obviously, UAE has been signatory to many double tax avoidance agreements, wherein also sharing of information across different jurisdictions also was there. Those provisions were there. Thereafter, UAE also introduced and agreed to implement the common reporting standards, which is, and FATCA, of course, and which has already been implemented, as all of you would have come across. And then the various taxes which started getting introduced, which began with excise tax in the end of 2017, VAT from 2018 onwards, and now the corporate tax. In between, of course, between 18 and 2022, when the corporate tax was announced, UAE also brought in a couple of other corporate compliances and regulations, mainly the economic substance regulation which mandates that any company which carries out some of the activities which are specified in the regulation, which is called as relevant activity, they need to have substance, and to ensure that the entity is carrying out businesses in a transparent manner, and it is not for the purpose of tax avoidance or evasion in any other country. Apart from that, the ultimate beneficial owner declaration regulation also came into effect, and which has already been implemented, wherein each and every entity which is operating in UAE is required to declare who the ultimate individual beneficial owner is. And this is also from the transparency perspective, so that the structures which were earlier being used and which continues to be used in some of the tax havens, whereby nominee arrangements and all those things gets declared and the beneficial owner is really identified. UAE also in last few years, you would have seen that has tightened various anti-money laundering regulations. And it has brought in various circulars and clarifications with respect to that. And very many businesses are directly now being asked to do additional compliances, mainly, real estate companies or brokers, the gold and jewelry, precious metal companies which are dealing with this. Also auditors, accountants, corporate service providers, lawyers. Very many entities are being requested to specifically do the anti-money laundering compliances. Having said that, it does not mean that the other entities are out of the purview of the anti-money laundering compliances. They also need to ensure that they also follow the anti-money laundering compliances. And the final, I would say, piece in this entire OECD action plan, which was there, the major piece, not the final, is this UAE corporate tax, because UAE so far had not taxed any of the businesses except certain industries, mainly which was relating to oil or extraction related businesses, which were being taxed at the state or the local level, and the banking industry, which continues to pay tax. However, the corporate tax brings into net all sort of entities as well as individuals who carry out businesses in UAE. So today in our presentation of 1 hour or so, we will try to cover in brief an overview of what the UAE corporate tax is talking all about, which me and my colleague Prasad and Kapil would be covering. And also I will like to highlight on, after the law which was announced in December 2022, there have been certain cabinet decisions which have been published, and which basically clarifies on some of the aspects which were stated in the decree law on the UAE corporate tax. So we will try to cover that at a broader level, after which we will have the question answer session. So as Jyotika mentioned, if you have any questions, please put it in the chat box, or you can mention, write your questions in the Q&A section, or you can raise hand in the Q&A section. So, we will unmute you so you can ask your questions. So over next 1 hour, 20 minutes or so, we'll try to cover in brief. Following this webinar, we will continue to bring additional webinars and sessions wherein we will deep dive into specific topics relating to UAE corporate tax, so that more clarity can be obtained on different aspects relating to the corporate tax. So the timeline, as I mentioned, January 22 it was announced, and now it is effective from first financial year starting from on or after 1st June 2023. So that's a journey of 1.5 year per se, wherein of course the law got announced only in December. So practically companies whose financial years are starting from June 23 or thereafter immediately will have very limited amount of time to plan and ensure that their systems, processes are in order and are in compliance with the things which are required as per the reporting standards laid down by the corporate tax law. So what I'll cover is who are the taxable persons, exempt, qualifying free zone person, and tax group, and of course small business relief, and also as well as exempt persons who are not required to register. So the taxable person, it primarily, as I mentioned, covers all sorts of entities which are registered in the UAE. So which will get covered under the juridical person. So whether it is a mainland company or a free zone company, all of them will get covered under this particular section. Even the offshore companies will be covered. Foreign juridical persons which are being managed and controlled in UAE. This would mean that if you have a company which is based in, let's say, a BVI, and all the shareholders, directors are based in UAE, the entire operations are being managed from UAE for that BVI company, and BVI company does not have place of operation and substance in BVI. Technically, they will fall under this provision and they will be considered as resident taxable person and liable to all the corporate tax rules and regulations, as well as natural persons who carry out business or business activities in UAE will get covered. Now, business activity is yet to be defined. That has not been specified by the law. That remains, for the cabinet to decide and issue a cabinet decision. So we are awaiting that. However, this would primarily mean that any form of businesses which are being conducted in individual name, whether you have obtained the license or you have not obtained the license, but if they fall under this business and business activity, it would get covered. Having said that, natural persons who earn, let's say, salary income will not get covered. Our understanding is also that natural persons who have some sort of investments in UAE or overseas and they earn those investment income will also not get covered. Primarily, they should remain exempt from the corporate tax. And of course, any other person as may be specified. Apart from this, there will be certain entities, foreign entities, which are not being effectively controlled and managed in UAE, but they either have a place of establishment in UAE, meaning they might have some sort of office or premises or presence, or they derive some UAE based income, or they have nexus with UAE, which is again yet to be defined. They will also be covered. So as you can see, it is a very wide coverage, and majority of commercial activities which are being carried out in UAE and generating income will be liable for UAE corporate tax. Now, there are many entities in UAE or partnerships which are sort of a civil company, which comes under the umbrella of unincorporated partnerships, because they are not incorporated as a separate juridical person. They don't have, that entity does not have a separate existence of its own technically, though they would have a license. These will get covered under unincorporated partnerships, which will be considered as tax transparent, which would mean that unincorporated partnerships will not be taxed, but the share of income and expense will get added to the individual taxable person, which is the partner, and then he or she will have to file the corporate tax return. However, this unincorporated partnerships can apply to be treated as resident person, and based on certain conditions and criteria, the tax authority could approve. Then the unincorporated partnership itself will become a taxable entity and will register separately and file separate tax return. Family foundations which are being incorporated and registered in DIFC, ADGM or RAC ICC also can apply to be treated as unincorporated partnerships, and this will be more for inheritance purposes and tax planning that could be carried out using this particular tool. There are certain entities which are exempt, which does not have to comply with or will not have to register also, as per the recent ministerial decision which has come out few days back. So these which are exempt are primarily all the federal and emirate government entities. So the federal and emirate governments, as well as the government entities or government controlled entities, obviously remains exempt. Apart from that, persons, which means entities which are or individuals which are engaged in extractive or non-extractive natural resource business, and they are liable to pay the emirate level tax, because each emirate levies tax on the extractive or non-extractive natural resource businesses. So they will remain exempt. Qualifying public benefit entity or investment fund or public private, social security retirement funds, these are all exempt. Having said that, the government also has come out with a ministerial decision which says that these government entities or government controlled or persons engaged in extractive businesses, they do not need to register also for UAE corporate tax, which would mean they will not also need to comply with the different provisions and filings and all that of UAE corporate tax. Apart from that, non-resident person, as we saw in the previous slide, that there are certain non-resident which derives only state-sourced income and they don't have a permanent establishment in UAE, also will be exempted from registering for corporate tax. So primarily, these also will get some sort of exemption. The law also mentions that qualifying free zone, which are going to be considered because, there will be companies based in free zone which carries out international business, and with a view to support international businesses being carried out from UAE, the corporate tax has a provision whereby they will not be charged tax, or they will primarily be liable to only 0% corporate tax, provided they fulfill certain conditions. And what are those? That, such companies will have to maintain adequate substance. So they cannot be just paper company without proper office, without proper, manpower or resources to carry out business. They will need to have proper substance in UAE. And they carry out and earn qualifying income. Now, what would be qualifying income has not yet been defined, and this is awaited by way of another ministerial decision. What our understanding again is in this, that primarily your export business or your business within the free zone person, with another qualifying free zone person technically, should probably be considered as qualifying income. Such companies will have to, of course, ensure that they comply with the arm's length pricing mechanism and the transfer pricing documentation, because the objective is that it should not carry out business and unduly make huge profits, whereas their other tax-paying entity in the mainland or other free zones, make smaller profit, and they just shift the profit from one entity to another just to get tax advantage. So these are the conditions. And of course, such companies can also opt to be out of the qualifying free zone regime, and they can opt for a normal tax regime of 9% and regular filing and all those, subject to certain conditions. So the free zone entities, primarily, if they are structured properly, and if they have international business or export business and income, they will continue to be tax neutral, in the sense that they will not have to pay tax on their income. However, they will need to comply with the tax law in terms of registration, in terms of annual filings, maintaining transfer pricing documentation and all that. So as you can see, the free zone companies also have a lot of obligations. Though they may not be liable to pay tax, that's a different thing, but they will have to comply with all the provisions. With this, the important part is now, as many of you are operating in a system whereby you have multiple companies which are carrying out the businesses in UAE, and also you will need to ensure that, are you registering individually as per the individual registration, or would you want to go for a tax grouping which is being permitted in the UAE tax law? And this is sort of quite a good provision, and this will be specifically beneficial if, let's say, you have some companies which are loss making and some companies which are profit, and eventually all of them together are carrying out the same business only for the purpose of your operational benefit and your probably ease of operations. You might have different companies at different emirates, for example in Dubai, Sharjah, Abu Dhabi, but technically they carry out the same business and is being controlled and effectively managed. They can be structured in a way whereby they could possibly then form a tax group. So the condition of tax grouping is primarily, it cannot be that the same person owns each company individually. It has to be a parent-subsidiary relationship whereby one parent company holds down the line subsidiaries, and at least 95% stake is there in the subsidiary shares, voting rights, as well as entitlement to the profit. So it's not just either of it, it is all of these have to be fulfilled. And This would ensure that one, you are filing and maintaining records as one entity, all the tax group which are in that, all the entities which are in the tax group are filing as one entity. And so that transfer pricing between the group companies also will not come into picture, because then there is no question of any profits being shifted, because it is as one group which is being complying with the tax law. However, conditions are there apart from this 95% parent subsidiary relationship. The other conditions are that they should follow the same financial year as well as the same accounting system. And of course, they cannot be exempt person or a qualifying free zone person. Otherwise, they are not entitled to be a part of a tax group. Of course, one limitation or issue or negative point out of this tax group would be that if you are registering, if you have, let's say, 4 companies which you register as a tax group, the minimum threshold for the entire tax group also will remain as 375. Whereas if you register individually each of the companies and file tax returns, then technically for each of the companies, you will have a minimum threshold, which is at 0% tax rate of 375,000. So technically, there is a possibility if you do a tax grouping, you might end up paying slightly more tax. So eventually one has to look at the business operations and take a decision which is more advisable and viable from the grouping perspective. The last part that I'll cover is on the small business relief, which is a very important decision which has been announced very recently, and which says that, and this is with a view not to put too much of tax and compliance burden on very small businesses which are carrying out businesses in UAE. So the government has announced that any business, any taxable person per se, is carrying out business and earns a revenue of 3 million. So it's a revenue, not profit, but revenue of 3 million during the tax periods, which is previous tax period as well as current tax period, can opt for a small business relief. So that would mean that they will not be liable for corporate tax, and technically they will be exempted from all the provisions. Of course, they will need to do the filing, because eventually they'll have to prove to claim the small business relief that they are below the threshold level. But the advantage is for a 2-year period, which is technically financial period starting from 1st June 2023 onwards till the financial period which ends before December 2026. So you can have primarily only 2 tax periods or 2 financial years. During that period, they will not be liable to pay any corporate tax. Of course, once you elect for this and you become eligible to claim small business relief, you will not be entitled to claim exemption of income, because there are certain incomes which are considered as exempt, or various reliefs which are available, or deduction from income, or you cannot set off or carry forward any tax loss which you might have had during any financial year, or you cannot even carry the interest expense which is not claimed or recovered. And of course, transfer pricing documentation also will not be applicable. So this is a very interesting relief specifically for very small businesses which are doing business and earning revenue of 3 million, less than 3 million dirham. Of course, they cannot be part of MNE, multinational enterprise group also. Now, one counter provision to this is if someone artificially splits the business just to claim small business relief. So if they have, let's say, a business which earns 5 million and you split it into 2.5, that is not permitted, and it will not be viewed favorably by the tax authority. And obviously they can disallow this, and they can then ask for the regular filing and levy tax and penalty on the total income. So artificial separation of business is not permitted, and so undue advantage should not be taken of this particular thing. The objective is genuine small businessmen should take benefit and advantage out of this. With this, I will conclude my part, and I will request Kapil to take it forward on his section. Thank you.
Good morning, everyone. Can you see my screen?
Yes.
Okay. I thank Vipul sir for giving us a brief on the corporate compliance scenario in the UAE and also sharing his thoughts on the various provisions of the corporate tax law. Moving forward from very left, in the next segment, we will be covering the four areas where of basis of taxation, the corporate tax rates, the exempt income, and the participation exemption. The first part is the basis of taxation, wherein we come to know of which income is will be subject to tax in the UAE. So for residents, in the juridical persons, their worldwide income would be subject to tax. As far as natural persons are concerned, their worldwide income derived from the business or business activities conducted in the UAE will be subject to tax. As far as non-residents are concerned, their taxable income from their PE in the UAE will be subject to tax, and their income which is the sourced from UAE, which is the state sourced income, that will be subject to tax. The third one is the taxable income that is attributable to the non-residents nexus in the UAE. So over here, the word nexus, what does it mean? What conditions are to be fulfilled? That is not yet specified in the corporate tax law as it stands today. However, we are awaiting a ministerial or a cabinet decision with respect to that, and whenever it comes, we shall update you on the same. The second part is with respect to the corporate tax rates. The UAE has kept a very simple slabs for the corporate tax rates. For up to 375,000 dirhams, there is no corporate tax to be paid, and for the taxable income above 375,000 dirhams, we have to pay 9% corporate tax rate. However, the UAE can also set up a differential tax rate for large multinationals, but however, as the corporate tax law stands today, this provision is not there, but it was specified in the FAQs issued by the Ministry of Finance. So we can expect whenever the provision comes, obviously the Ministry of Finance will update us, and we will get back to you on that. So with respect to the UAE resident companies that are subject to corporate tax on their worldwide income, but those will be allowed to claim the foreign tax credit as the lower of whatever the tax is paid in the foreign country or the UAE corporate tax payable on the foreign sourced income. The excess credit shall not be refunded or not carried forward. So we can have an example wherein a UAE resident company is having an income from India, and the Indian client is deducting TDS or they are paying tax in India because of their income. And obviously, India has a higher tax rate. So the higher tax rate which has been paid in India, that you cannot take the credit off because UAE is leaving only 9%. So only the portion which is the apportioned to the foreign sourced income, the corporate UAE corporate tax on that will be claimed. However, for qualifying free zone persons, the department has, the FTA has given a differential tax rate wherein the qualifying income will be subject to 0% and the other than qualifying income will be subject to 9%. The word what would constitute in the qualifying income is not yet defined, and we are expecting that in further cabinet decisions. The next portion is with respect to the exempt income. The dividends and the other profit distributions received from a resident juridical person will be exempted. Similarly, the dividends and the other profit distribution received from a participating interest in a foreign juridical person will be exempted. Now, what is a participating interest? We shall be covering in the next slide. So we'll be understanding what it is. Any other income from participating interest will also be exempt. The income from a foreign permanent establishment will be exempt, but that would have certain conditions prescribed to it. The income derived by a non-resident from operating aircrafts, ships in an international transportation shall also be exempt. However, there shall be separate conditions prescribed to that as well. Now we move on to understanding what is a participating interest. So participating interest basically means having a 5% or a greater ownership in shares or capital of a juridical person, where a few conditions are met. Those conditions are, foremost, those shares should be held, or at least we should have an intention to hold the shares for at least 12 months. And the juridical person where we are investing should be subject to corporate tax of at least 9% in his juridical resident jurisdiction. The third condition to be fulfilled is that the investor company, the investor entity, should be eligible to receive not less than 5% of the profits available for distribution and 5% of the liquidation proceeds in case of cessation of the investee company. So all these three conditions collectively are to be fulfilled in order for the investment to be considered as a participating interest. Now, if we fulfill these conditions, what would be exempt is the income from participating interest shall be exempt, including the following: the dividends and other profit distributions received from the participating interest in a foreign juridical person shall be exempt. Any other income from a participating interest would be exempt, wherein we can consider as a capital gain, that can be exempt. If we understand it with the help of an example, suppose there is a mainland company that has invested in a UAE free zone, or a mainland company, another mainland company. So the capital gain, and assuming that all these three conditions are being fulfilled, so in this scenario, if we are getting a capital gain from sale of those shares, though that capital gain will be exempt under this article. In a second scenario, wherein the mainland company is making an investment in a foreign subsidiary, and assuming again that all these three conditions are being fulfilled, in this scenario, dividend and capital gain both will be exempt. One thing to note here is that in the first example which I shared, the UAE free zone company, a question can be asked: how can a UAE free zone company, assuming that if it is taking the benefit of a qualifying free zone person, how can that be subject to 9% tax? So in that, there is a provision wherein the corporate tax law specifies that in this situation, it would be assumed that this condition is being fulfilled by that UAE free zone entity as well. Another thing to take note of it is that in the first scenario, wherein the mainland company is investing in another mainland company or a free zone company, the dividends are automatically exempt under the exempt income article, because for the domestic dividend received, there is no condition to hold 5% or more shares. Even if you hold 1 share, 5 shares, 10 shares, or minimum number of shares, even that the domestic dividend is exempt naturally. So in the next scenario, we will understand this participation exemption with the help of a few examples. Number one is assuming that we have a UAE mainland company, it is holding shares in three companies. One is another UAE company, wherein it is holding 4% shares. Since this is a UAE company, the investee company is a UAE company, dividend would be automatically exempt. We don't have to fulfill any conditions with respect to that. However, the capital gains would be taxable, because the UAE investor company is holding only 4% shares, and in order to consider it as a participating interest, it has to hold at least 5% or more shares. In the second scenario, if the UAE mainland company is investing in a Indian company and having a 10% or more stake in the Indian company, so the first condition, we see that it is fulfilled, that it is holding more than 5%. The other three conditions, wherein assuming that it is holding shares for an uninterrupted period of 12 months, and since being an Indian company, it has a corporate tax rate of obviously more than 9%. We all know that. So the dividend and capital gains both earned from that Indian company would be exempt here, according to the participating interest article. The third company, the UAE mainland company would be investing, it would be a wholly owned subsidiary in Bahamas. So even though it is a wholly owned subsidiary in Bahamas, we are holding more than 5%, we are holding in fact 100% of the shares. We are holding it for more than 12 months. But since the Bahamas itself does not have a corporate tax structure, because of that, this one condition of that 9% is not being fulfilled, the dividends and tax capital gains received from that Bahamas company would be taxable. Understanding it in more of a detailed scenario with the help of a few dates, we take another example wherein the UAE mainland company is continuing with the earlier example. The UAE mainland company is investing in the Indian company, is holding 10% shares, and assuming that the shares are acquired in the month of December 2024. This mainland company, we can say for example that it is having a tax period of the calendar year, which is January to December 2024, and for during that calendar year we are investing in the month of December 2024. So the first condition with respect to the 5% stake is being fulfilled. The second condition with respect to the intention to hold 12 months, that we understand that it has an intention to hold the shares for 12 months. That is also being fulfilled. The Indian company pays more than 9% tax in India. So all the conditions are being fulfilled. So the dividend which it will receive from the Indian company will be exempt as per the UAE corporate tax. And when the corporate tax return will be filed in the month of by the month of September 2025, in that return we shall claim this dividend as an exempt, even though 12 months have not passed by from the date of investment, because we have an intention to hold for 12 months. However, subsequent to the filing of return in the month of September 2025, there are circumstances wherein we have to sell those shares, and the intention to hold for 12 months is not being fulfilled. Suppose if we sell the shares in the month of October 2025, so that we are not holding it for 12 months because we purchased it in December 2024 and we are selling it in October 25. So since this condition is not being fulfilled and we had claimed it as an exempt income in 2024 return, when we file for the return for the tax year 2025, the same amount of dividend that was treated as an exempt income in 24 shall be considered as a taxable income in the corporate tax return which we filed for 2025. So this is how participating exemption and the participating interest scenario works. So now I will hand it over to Prasad sir, who will take us forward with respect to the next scenarios.
Thank you, Kapil. I'll be just sharing my screen. Kapil, can you please stop sharing your screen? Thank you. So can all of you see my screen?
Yeah, we can.
Yeah, thank you. So thank you, Vipul sir. Thank you, Kapil, for your insights on the corporate tax law. So I'll be taking up these topics. I'll be touching on the taxable income. What are the deductible expenditures, non-deductible expenditures? How do we compute the taxable income? The concept of withholding tax, certain rules regarding carry forward losses, and transfer of assets provision, and certain tax compliance details. So let us just dive into this first part. So corporate tax, as we saw, is on the profit. So for arriving at the profit, our starting point will be the net profit as per our financial statements. Now, how do we calculate the net profit? So net profit will be calculated as per the International Accepted Accounting Principles, IFRS. Usually in this part of the region, we all follow IFRS, full IFRS or IFRS for SMEs. So the accounting profit calculated as per the IFRS will be the starting point of calculating the taxable income. Now there will be certain adjustments to be made in this net profit or accounting profit based on the deductions which are allowed or not allowed. Those adjustments need to be made in this net profit. After making those adjustments, whatever remains will be taxable income on which the tax rate of 9% shall be applicable. As I said, the starting point is the net profit based on the finance statements. Finance statements have to be or should be based on the accrual system of accounting. The law does state a provision for making the accounts as per cash system, subject to certain conditions. However, accrual basis of accounting will be preferred. The financial accounting period will be the same as your financial year, which the company is following. That also will be your tax year. What are the adjustments to be made in the net profit? That we'll see in the coming slides. Before that, there is a foreign branch exemption given in the law. So UAE company's foreign branch can elect to claim foreign tax credit for taxes paid in the foreign country. So if you have a foreign branch, if a UAE company is a foreign branch, and that foreign branch is subject to the tax regime of that respective foreign country, and they have paid taxes in that foreign country, foreign jurisdiction, then that tax credit can be claimed in the UAE. So the profits of the foreign branch may be exempted from the UAE taxable income. Obviously, there are certain double taxation avoidance agreements UAE has entered into with a lot of countries. Those in these situations, whether the foreign income or foreign branch income will be taxed in the UAE or not, all these foreign agreements will come into picture. In case there is a conflict, then the relevant international agreement may limit the application of UAE corporate tax law. So if there is a conflict between the corporate tax law provision as well as the international agreements, then the international agreements will prevail and the application of CT will be restricted to that extent. Now, what are the deductible expenditures as per the corporate tax law? We saw in the previous slides that your net profit will do certain adjustments in the net profit to arrive at the taxable income. So what are these adjustments? So just let us look into those adjustments. So the first thing is that the expenses which will be allowable will be all expenses which are in relation to the person's business. So all expenses which are deductible or allowable have to be in relation to that person's business. They should not be expenses of any personal nature or which are not related to their business. Those expenses will not be allowed. And those expenses should not be of capital nature. So capital expenditures will not be allowed as a deduction from your profits. Also, if you have incurred any expenses to generate non-exempt income, those will be allowable. But if you have expenses which you have generated exempt income, then any expenses in relation to the exempted income expenses will not be allowed as a deduction. Then there are certain specific caps given in the corporate tax law. One of such cap is for the interest expenditure. Now, when we talk about the interest expenditure, they say interest is net interest. They are talking about net interest, that is interest expense minus interest income. So the maximum interest which can be claimed in a particular tax period is capped at 30% of EBITDA, that is earning before interest, tax, depreciation and amortization. So maximum 30% of EBITDA you can claim as an interest expense deductible in the particular tax period. So then what happens to the balance interest? Suppose you have some interest which is not, you have reached the maximum 30% limit and you are not allowed to claim the balance. Then what happens to that? The corporate tax is allowing us to carry forward that interest for the next subsequent 10 years. So you can carry forward that interest for next 10 years and claim that as a deduction in the following years. However, in the following years also that 30% cap will still be effective. So if next year also you won't be able to claim, then you can carry forward to the subsequent tax years, and you can do that for the next 10 years. Then entertainment expenses are allowed only up to 50%. So whatever entertainment expenses you have incurred, only half of it will be allowed as a deduction. And another important aspect regarding deduction for any expenses or payments made to connected person. Now this is a very important and a tricky aspect of corporate tax law. So they are saying that if you are making any payments to a connected person and you are claiming any deduction from your profits, then those payments or those expenses have to correspond to the market value. So arm's length principle has to be considered, has to be satisfied while making any payments to a connected person. This implies any sort of management remuneration, management fees. You're paying salaries to your managing directors, your other directors, your relatives of directors. All these will be treated as payment to connected person. Now, what is a connected person? In brief, they are the owners of the company, the related party of the owners, directors and officers of the owners. We have related parties of directors and officers. The connected person definition is very wide. We will see that definition in the upcoming slides, but they have included a wide definition of connected persons, and any payment made to these persons have to be at market value, have to satisfy the arm's length principle, and then only they can be claimed as a deduction from your profits. If they don't satisfy the arm's length principle, in that case, then those deductions will be disallowed. And obviously, these payments made to them have to be solely for the purpose of the business. They have to be in relation to the business. Then only they can be allowed as deductions. Then what are non-deductible expenditures? So these are specifically expenditures which are not allowed to be deducted from your profits. So donations, grants, gifts which are made to non-qualifying public benefit entities. So those entities which are not registered or not qualifying, if you made any donations to them, they will not be allowed. Fines and penalties will not be allowed as a deduction. However, if you are making any compensation you are giving for any damages or breach of contract, that may be considered for deduction. Otherwise, general fines and penalties are not allowed. Bribes and other illicit payments are not allowed. Payments for getting contracts or getting some favors, all those things will not be allowed. Dividends, profit distributions will not be allowed. Anyways, dividend is not an expense, it is a part of appropriation. It is profit distribution. So anyways, it will not be allowed as a deduction. Drawings made by the natural person, the shareholders who are making the drawings from the business, they will not be allowed as a deduction. Input tax, which is recoverable, will not be allowed as a deduction since you are already recovering the input tax in VAT. So you cannot claim that as a deduction. Any corporate taxes imposed outside UAE, that you cannot claim as deduction. So these are some few brief on the deductible and non-deductible expenses from a profit in arriving at the taxable income. Here's a small example of how do we calculate a taxable income. We start, as we discussed, we start with the net profit as per your financial statement. Say it is 1 million. Then we do the adjustments, whatever is allowed, not allowed, based on the discussion we just had. Say it comes to 200,000. So now so 200,000 is a not allowable expenditure. So that we added back to the profit because it was not allowed. So our total taxable income comes to 1.2 million. How do we calculate tax on that? So for the first 375,000, tax rate will be 0. And on the balance 825,000, tax rate will be 9%. So your total tax liability for this period will be 74,250. Then the law also prescribes withholding tax provisions. So currently the tax rate is 0%. That may be modified in the future. However, the tax rate for withholding tax is 0%. What is withholding tax? So withholding tax is the prevailing tax rate to apply on UAE sourced income derived by a non-resident person to extent not attributable to non-residents permanent establishment UAE. So any non-resident person getting an income from UAE, and that non-resident person does not have a permanent establishment in UAE, then the person paying, the UAE resident paying to that non-resident person has to deduct a tax, which is called withholding tax, and pay the balance amount to the non-resident person. As of now, the withholding tax is 0. So right now we don't need to deduct anything while making payments to foreign suppliers. However, if the tax rate changes or they modify the rate, then withholding tax might need to be deducted. If you deduct this withholding tax, then you can offset this against the corporate tax liability to the extent. However, any excess withholding tax credit shall be refundable. Then there are certain provisions for carry forward of the tax losses. So, as we discussed, the corporate tax is on the taxable income. So, suppose you don't have an income, you have a loss. Your expenses are more than the revenue. In that case, you have tax losses. Then there is no question of any corporate tax being applicable. However, we have quite a progressive regime, and because of that, they are allowing us to carry forward these losses in the future years. You might have seen that carry forward of losses in a lot of other tax jurisdictions, they are restricting to for certain periods, maybe 5 years, 10 years, they can carry forward. However, as far as the UAE Corporate Tax Law is concerned, they have not specified a period. So these losses can be carried forward indefinitely till they can be set off against future profits. However, there are certain conditions for carry forward. Maximum you can carry forward is maximum set off is allowed as 75% of taxable income in each future periods. Carry forward is same shareholder at least owns 50% of share capital. So in the future, also if the shareholding changes, then the shareholder should be owning at least 50% of that share capital in order to get this benefit. If the change in ownership is more than 50%, then tax losses may still be carried forward provided the business activities same, or it is the activity is not changed. So if there is a change in shareholding beyond 50%, then also carry forward is allowed. However, the activity of the business should remain the same. Then there is also a provision of transfer of losses between group companies. So suppose you have two group companies where one company is making profit and one company is making loss. Sorry. Then in that case, you can set off one company's loss against the other company's profit. Obviously, there are certain conditions. First condition is both should be resident person and judicial persons. And both the companies, there should be a direct or indirect ownership of at least 75% of the share. There should be common ownership of at least 75%. None of them should be exempt, or they should not be part of qualifying free zones. And they should be following the same financial year and the same accounting standards. In that case, then the profits and losses of two group companies can be set off. Then there is also relief for intra-group transfer of assets and liabilities. So if you are transferring assets or liabilities between group companies, then corporate tax impact can be avoided, provided there are certain conditions. Relief for transfer of assets and liabilities between UAE group companies if assets are held for minimum of 2-year period and at least 75% in common holding. So that is the basic condition, that two companies, if they are transferring assets and liabilities between them, then both the companies have to hold at least 75% common ownership has to be there, and the asset must be held for minimum period of 2 years. Transferor to pay tax if such conditions are not met. So if these conditions are not met, then obviously it will be treated as a normal transfer. Exemption allowed for deferral of taxation, whether whole business or independent part of business are transferred in the exchange for shares or other ownerships. Also, the transfer between the group companies have to be at book value. Then this relief can be claimed. And there is also crawlback provision. If this asset is sold within 2 years, then whatever amount was transferred can be crawl back and be a part of the income and shall be taxed. Certain tax compliance related matters. So every company has to obviously register a corporate tax, and they'll be getting a tax registration number. Filing of corporate tax returns and tax payment. The law has prescribed a 9-month time period. So from the end of the financial year, you have 9 months to file the corporate tax return and make the payment. The tax regime, UAE tax regime, is based on self-assessment principle. So you will have to calculate your tax, calculate the taxable income by doing adjustment to your net profit, calculate the tax, file the tax return. So it is a self-assessment principle. Option to apply FTA for clarification in case of uncertainty of tax treatment. You can apply to the FTA for clarifications. You have to maintain financial records. That goes without saying. You have to other supportings for all supportings for financial records. Your whatever you are claiming as deduction, exemption, transfer pricing documents. All supportings need to be maintained, and they have to be maintained for a period of 7 years. So, as you are aware, for VAT, the period mentioned is 5 years. However, in corporate tax, the period mentioned is 7 years. So, for 7 years, you have to maintain all the accounting records which support your corporate tax return declarations. Qualifying free zone will also have to file tax returns and finance statements to claim benefit of 0%. So all qualifying free zones who are claiming the qualifying free zone exemption, they also have to register for corporate tax. They also have to file the corporate tax return. This is the example of when the first tax period will be. So if you are following the year end of 31st March, then the law says that corporate tax will be applicable for financial year starting on or after 1st June 2023. So if you are following a financial period of 31st of March, then your tax period will be from 1st April 24 to 31st March 25. And your first corporate tax return will be 9 months after the end of your financial year. That will be on 31st December 2025. Same way, December, if you're following December, then your corporate tax period will be from 1st January to 31st December. And 9 months after that, September 25 will be your corporate tax return filing deadline. Same way, June, 1st June 23 to June 24 will be your first tax period if you are having the June year end, and your corporate tax filing deadline will be 31st March 25. And you have to make the tax payment also within 9 months from the end of the financial year. So I think this is the end of my presentation. I now request Vipul sir to take the presentation forward.
Thank you, Prasad, for covering this topic. So I will just share the screen. 1 minute. Okay. I hope you can all see the screen.
Yes,
so I'm covering primarily two very important aspects now in next 5 to 10 minutes. One is on the related parties and transfer pricing, and the general anti-abuse rule provisions. So as Prasad mentioned, the related parties definition is very, very wide. And, that covers primarily 2 or more natural persons up to the 4th degree of kinship, or natural person with RP, which are directly or indirectly, which owns 50% or more in a juridical person or which is entity, or exercises control. So which can be by way of voting rights on or seat on the board, or right to 50% or more of profits or influence over that business. So it's very widely defined, and the objective is that primarily the tax evasion should not happen using the transfer pricing mechanism, whereby one company which is liable to lower or 0% tax transfers the profits to, gets the profit from the taxable company which pays a higher profit. So this related parties is one thing which will have to be looked at, and the important aspect is in the UAE Corporate Tax Law, transactions with the local, which is the UAE based entities, as well as foreign entities, will come within the ambit of transfer pricing. So domestic as well as international transfer pricing will have to be followed, and the required filings in terms of transfer pricing documentation, which has not been still specified what exactly will need to be filed, because the tax return format and all that has not been published. But we are assuming that in line with the international standards in terms of local and master file and all those, will be required to be submitted. Now, what the companies will have to first identify is which are the companies or individuals with whom they are carrying out business activities who will fall within the related parties definition. And once these have been identified, then all the transactions which are being carried out with these related parties will need to comply with the transfer pricing rules and arm's length principle, which would mean that transactions with related parties should be also at the same pricing or similar pricing as you might do with any third party, whether you are buying or selling. It should be on arm's length principle basis. The law has specified that, they've given flexibility that which of the transfer pricing formulas or the rules that you would follow, which could be comparable uncontrolled price method, resale price method, cost plus transactional net margin, or transactional profit shift method. So the option is available to the entities, whichever method which best captures the arm's length principle would be and will need to be followed. And of course, as I mentioned, the documentation will need to be submitted about the transactions with related parties and also connected person. Now, connected person again would cover shareholders, directors, officers, and so primarily the salaries which are being paid, remuneration which is being paid to connected person, or any other benefits which are being given. Are they also on arm's length principle basis? Meaning, if a director who is a shareholder also, and he's a director and he's managing the company and drawing a remuneration, is that justified? Now, it's a very subjective thing, because they've not specified exactly what formula to use or what mechanism to use, but they say arm's length principle, which would mean, let's say, if you hire an independent managing director, for example, how much would that person would have costed? How much would the company may have paid to such an independent person to manage? That could be sort of a arm's length principle and the realistic remuneration that could be considered as allowable. So this is very, very critical. As far as the law is concerned, if you have seen, it's not very complicated, not very difficult to interpret as well as implement. However, there are these kind of things which will need to be taken care of. And that's why one needs to be very, very careful in determining who the related parties and transactions with them are, and determine the transfer pricing mechanism with such parties. The next important part is on the general anti-abuse rules, which means that after the decree law, which was announced in December 22, if you carry out any restructuring, for example, or any changes in your structure or processes or systems or anything, which is with a view to avoid the tax or with a view to take undue tax advantage, it could fall foul of the general anti-abuse rules. And that would mean that such restructuring or such transactions which have been carried out could be disallowed by the tax authority. A very simple example is that, a company which earns, let's say, 600,000 of dividend, and because participation exemptions are not met, the entire 600 will become a taxable income. And then obviously net of 375, they'll have to pay tax on the balance amount. Now, in order to avoid taxes, someone just splits it into two entities, the shareholding, and gets the income of 300 and think that, they'll be out of the purview of UAE corporate tax. They will fall foul of the anti-abuse rules because they have done this restructuring and change of ownership only to avoid or evade the taxes, and which is not acceptable. So primarily, such type of changes will be disallowed, and that's why one needs to be careful in looking at what restructuring is permissible and commercially justifiable and what is not, and accordingly do their planning for implementation of the corporate tax. With this, of course, there are, as Prasad and Kapil mentioned, there are broadly, at a glance, if you see effective from June financial year, starting from June 23, tax groups can be created, dividend income exempted subject to conditions, 9% for majority of companies above the threshold. Payments and returns to be filed within 9 months, losses can be carried forward, and qualifying free zones would be eligible for 0%. Transfer pricing would apply, and books of accounts will need to be maintained for 7-year period, which is a long period because assessment can happen at any point of 7 years, which would mean that today, let's say for the first financial year, your financial year is Jan to December 24, you file in 25 somewhere. So technically, for next 7-year period, authorities can any point of time up to 31 come and ask and reopen and do the assessment. And if they disallow certain expenses as claimable, non-claimable, or as add back some income, and your corporate tax liability goes up, that would mean your corporate tax liability, when assessed in 2031 for the year 2024, could go up, which would mean that you'll have to pay the differential, as well as there will be penalties which will get accumulated and interest accumulated over a period of next, from 24 onwards till 2031. So all of these are very, provisions that needs to be taken care of, and hence it is very essential that the implementation is carried out in a proper manner. Of course, the penalties and the fines and all those interest provisions, what would be charged on delayed payments of tax, all those have still not been announced. Those are also awaited. So what are things which are awaited are clarifications on nexus, of course, allowable and not allowable expenses, more or less it's there, but qualifying free zone, again, which will be the qualifying free zone or free zone persons and income under that. Specifically, business and business activity for natural person is one very important clarification. Differential tax rate for multinational corporation, because UAE has already agreed to global minimum tax rate, and which is going to be implemented, but from when it would be implemented, and they would be liable for a global minimum tax rate of 15% or whichever is prevalent at that time. So these are clarifications which are awaited, which we expect should come in hopefully now within the next 1 month, because the clock is ticking, and effective from June 23 onwards, the companies which are the first implementers, whose financial year starts from 1st June 23 onwards, will have to start implementing and ensuring that their books records are all in proper order and systems are all in place. So technically, if you see now, a very limited time is now left for people to implement. And as I mentioned, the law seems simple enough in terms of implementation, barring a few matters like, the related party or connected persons, arm's length principle, non-deductibility of interest, or limit on deductibility of interest, or carry forward or transfer of losses. Other than that, I think other provisions are quite simple enough. But having said that, on the important matters, if something is incorrectly interpreted and incorrectly applied and implemented, what would happen is that incorrect interpretation and your consequential reporting will carry on for, let's say, till the time the first assessment for 2024 happens, or any assessment happens, which could be over a period of next 5 to 7 years. And till that time, you would continue doing that error or mistake, and that could result into penalties and interest, and it could multiply. And that's why it is very, very important that the key aspects relating to this corporate tax should be professionally evaluated, and decisions should be taken to interpret it in the right way and implement it properly. So that's why it's now time that every company evaluates their businesses, companies, activities, and starts implementing in terms of restructuring their accounting system or documentation, paperwork. Because many a times you have multiple companies, but books of accounts are maintained as one common entity. Now, this is not going to be accepted again, because every company will have to register separately and file separate tax returns, and which would mean that you will need separate books of accounts. So there are very many things which will need to be done, and that's where we can come in and help you, guide you with the impact assessment, planning and implementation support, and of course operational support for filing of the first VAT return, first corporate tax return. With this, I will conclude on our presentation, and the floor is now open for question answers. I will request Jyotika to check the questions, and we can take the question answers.
Thank you, sir, for the insight. We'll now take up the questions one by one. First question: will a branch office and liaison office outside the UAE income will be taxed in the UAE? If yes, whether any double tax exemption or deduction can be claimed for the tax period in branch office country?
Yeah, so as we discussed, the branch offices, if the branch office are subject to tax in the foreign jurisdiction, then that they can claim a tax credit for the amount of tax paid in the foreign jurisdiction, and they can claim exemption for that.
Thank you, sir. Will a BVI company having investment income and having its directors in UAE have to register for corporate taxation?
Yes, because if the place of management, effective management and control is from UAE, meaning, let's say if shareholders, directors are based in UAE, all key decisions are being taken in UAE, technically, then that BVI company is effectively managed and controlled from UAE. And that would mean it becomes a resident taxable person, which will require them to file and do the registration and filing.
Thank you, sir. Next question: what will be defined as capital expenses?
So as such, there is no definition as such in capital, but we can take a general definition as per the accounting standards there. So capital expenditure would be an expenditure which the benefit of that is not just limited to a single year and can be derived for a number of years and parts of your assets, specifically fixed assets. So in that, that is a capital expenditure. Obviously, depreciation will be allowed on that, depreciation and amortization. So that is that.
So this will be more in line with, it mentions that you have to maintain your books of accounts in line with the accounting in IFRS primarily. So as per IFRS, again, it will clearly define what are capital expense of capital nature and what will be considered as the revenue nature.
Thank you, sir. Next question: is there any other cess on the 9% tax?
As of now, no, nothing, only 9%.
Next question: is there any advanced tax provision?
No, the law does not have any advanced tax provision. So you basically have to clear all your liabilities within 9 months from the end of the financial year.
Thank you, sir. Is the UAE a part of OECD?
UAE is a signatory to OECD's BAP section plan, and that is where it has implemented, all these changes that we have seen in the last 5 to 7 years. So obviously it is implementing and agreeing to, and globally now, if a jurisdiction wants to be considered as a reputed jurisdiction open for international businesses and where you want to invite large businesses to come in and set up base, which UAE is doing, it will have to follow the international norms, which are defined by whether it is OECD or Financial Action Task Force, which is FATF, which monitors the anti-money laundering and terrorist financing matters. So these things will have to be agreed, and which UAE has wisely agreed to, and it is implementing it at a fast pace.
Thank you, sir. Next question, have the depreciation rates been specified for deduction as deductible expenditure?
No, depreciation rates have not been specified as of now. So we are awaiting that. If the rates don't come, usually they will be as per the generally accepted norms or as per the accounting standards. But however, we are expecting some kind of clarification as far as depreciation is concerned.
With this, I'll like to just add that generally, see what happens again, if you follow IFRS, it says basically it has to be depreciated over useful life of asset. And primarily, there are certain depreciation methods which are permitted. So you follow those based on the useful life of asset, that should be acceptable, I believe.
Thank you, sir. If any revenue is generated through import of service in foreign countries, will it be considered for CT?
Import, sorry, I didn't get the question. Import of revenue through import of service. Now,
Looks like export of service.
Yeah, it should be export, because see, when you're importing service, you have to pay for it, which is an expense. Now, then when you render service, and then you provide service to someone and you generate revenue, that could be as a foreign, qualifying, probably could be considered as a foreign qualifying income. And if you're in a free zone, you might get deduction. But however, we have to still wait for the clarification on qualifying income. And whether qualifying income would include the goods only income relating to or income relating to services rendered to foreign companies remains to be seen. It ideally should, because in VAT also it allows export of service at 0 rate.
Thank you, sir. Next question, what is the tax period for financial year ending 31st May?
So that will be, so 31st May is your year end. So that will be from 1st June 24.
1st June 23, no? Effective on or after 1st June 23.
1st June 23, sorry.
Yeah. So June 23 to May 24.
24.
I mean, they are the first implementers, I would say, of the corporate tax.
Next question, how to register for corporate tax?
So as of now, the registration is open via invitation. So FTA is sending out invites for corporate tax registration. So once you get an invite from the FTA for registration, you can register yourself through the Amara Tax portal. So we are expecting that the registration will be open for all licensees, mostly after June. As of now, it is based on invitation from the FTA. So you'll have to keep your emails, keep an eye on your emails for any correspondence from the FTA.
And also, I think, monitor the Amara Tax portal if that option of registration has been opened for your company or not.
Thank you, sir. Is there a deadline for CT registration?
No, as of now, there is no deadline as such. In fact, I think you can register, I guess, anytime before the filing of the return. So before the filing of the return, you have to register yourself. So as of now, there is no deadline, unless the authority comes out with some deadline.
What would happen is, see, the penal provisions have not been announced or defined yet. And penal provisions would more or less cover all these, that failure to, register before the deadline or, before such and such period, it would attract penalty. I think we'll have to await those, again, cabinet decisions with respect to such penalties and penal provisions.
Thank you, sir. Next question. If the shareholders are non-residents of the UAE and residents of India, would capital tax be applicable? Also, is the threshold limit of 375,000 of profit or revenue?
So see, they are non-residents, and I'm assuming they are, see, natural persons, as far as it is concerned, individual is liable to tax on income which they generate from UAE, whether they are resident or not resident, does not matter. But income, what they generate from UAE, whether that falls within the business or business activity, will need to be looked at. Now, that what will constitute business or business activity for natural person is yet to be defined. That has not been clarified. So we'll have to wait and see what is the income that they are generating and whether that falls within the business or business activity related or not. And based on that, we will have to. Now, I'm assuming this will be property investment because capital gains they are mentioning. So if it is property investment, I believe it could be out of the business activity purview or perspective. It might be considered as investment. But again, this is all assumption. Unless and until we have clarification, we can't really say. Yeah, what was the second question? The revenue and yeah, so obviously the 375,000 limit is of the taxable income. So threshold is of taxable income. So up to 375,000 of taxable income, meaning let's say taxable profit, you don't pay or you pay 0%, and beyond that you pay 9%.
Okay, sir. Next question. Is there any tax on individuals, those who earn income, for example, directors of free zone companies who are foreigners?
See, again, if it is as a not constituting business or business activity for natural person, because directors are natural person who are foreigners and they are not conducting business, but they are working. It is an employment, for example. Directors, as a director, they are employed in the company and they are generating remuneration by way of salary and compensation as a employment compensation. So then that would be out of purview of UAE corporate tax, because that is not considered as business or business income.
Okay, sir. Will the FTA provide tax deduction summary like we have Form 26As in India? Also, are there any TDS provisions?
There are no TDS provisions in UAE. So since there are no TDS provisions, there are no list of tax deductions which you will be granted with the UAE tax authority. So there won't be any Form 26 C or I think AS or whatever is being issued in India similar to that, because in India you have TDS. Here you do not have any TDS. So that question does not come into play.
Thank you, sir. Assuming all free zone companies are in the scope for corporate tax, if they meet the conditions and requirements as mentioned in the presentation, that is, are there any free zones that are exempt?
See, the free zones which will be considered as qualifying free zones, also the conditions have not been defined. Which free zones will be qualifying? Of course, in VAT, they had defined designated zones, which were not all the free zones, some of the free zones. I believe, similar list should come out that which all free zones will be considered and companies registered in which free zones will be considered as qualifying free zone person.
Okay, sir. Is there a limit to such income for directors or business owners?
There's no limit on income that directors could. I believe this is with respect to the director's remuneration, which they charge to the company and which could be considered as deductible expenditure to arrive at the taxable profit. If that is the case, as we mentioned, it has to be on arm's length basis. So a shareholder director or any third party director, I mean, if you are hiring, and specifically so if he's a shareholder who is entitled to eventually profits and liable to tax, he will need to be paid on arm's length principle basis. So if, let's say, the market value of an independent director is, for example, 500,000 dirham, and you pay 2 million dirham to your own self and consider it as deductible expenditure, no, it will not be acceptable.
Okay, sir. What accounting standards need to be followed? Is it IFRS or GAAP?
Yeah. So technically, generally accepted accounting principles. In this part of the region, everyone follows IFRS. Even the central bank also has advised on following IFRS. But I don't think GAAP also would be is also generally accepted accounting principles. So I don't think GAAP also would be an issue. Vipul sir?
I don't think that should be an issue. See, only challenge will come if there are material differences in income or expense recognition because of following IFRS and GAAP, in which case, obviously, the IFRS would be preferred. So if you follow GAAP and then that results into probably more provisionings, resulting into less of your taxable profit and less corporate tax, that could get challenged.
Thank you, sir. Will AML certificate be required for freight forwarder services?
AML certificate for freight forwarder, I do not understand the context of this. So if that person is connected and would wish to clarify, he can raise hand and we can clarify. Or we can type in another question giving details of what exactly he wishes to clarify. Meanwhile, we can move on with the next question.
Yes, sir. When an overseas branch transfers the profit in part among years, how will the tax credit be applied or computed? Only on current year transfers or proportionally?
Foreign company, can you repeat that? Foreign company?
When an overseas branch transfers the profit in part among years, how will the tax credit be applied or computed?
See, whether you transfer profit or not, eventually branch is considered as a part of the main company. So as far as your accounting standards or filing or reporting is concerned, it will be considered as, and law also clearly says that branch will be considered as one and the same as the taxable person. Now, technically, whatever branch generates is considered as profit of the main company, and main company is liable to pay tax. Now, if you fulfill the conditions of exemption, you can claim an exemption on the foreign branch, profit, so that you don't have to pay tax. Or else entire profit gets clubbed. Your entire revenue, expenses, line to line gets clubbed with your parent company, and whatever taxable profit you pay tax and then claim foreign tax credit. So these are the two options which Prasad had covered. So, they can look at these two, but there's no relation whether you remit or you do not remit, because it's not a subsidiary. Had it been a subsidiary, yes, subsidiary is a separate entity. Subsidiaries' profits are not considered as part of parent company's income unless the dividend is declared. Whereas in case of a branch, there is no question of any profit transfer or dividend declaration.
Thank you, sir. Next question. What documents or IDs are required for registration?
So I think just right now for registration, VAT registration, basic documentation, the legal documentation of the company, as well as the IDs of the owners or the authorized representatives are required. So the documentation which they are asking for is not much in detail. Basic legal documents of the business are required.
Yes, sir. How will CT be applicable to offshore companies because they are being operated through registered agent address only? And how will they make the substance according to CT?
This is the most challenging part. You have an offshore company, whether it is in UAE or it is overseas offshore company, substance is most difficult aspect to really, create. Unless and until these offshore companies have a place of operation, they have employees and they carry out business, which becomes difficult because in UAE, offshore companies cannot have businesses, offices and all that. They have only registered agent. So this is going to be the challenging aspect of proving substance in offshore company, and hence claiming, let's say, the benefit under qualifying free zone, if it is considered even that as qualifying income, whether they will be able to claim benefit of zero tax or not, this will need to be seen. And in overseas also, BVIs and all these places also, these are only paper shelf companies, technically does not have any offices or anything, and you can't really have anyone operating from there. So that's a challenge. Offshore companies will probably not get the benefit.
Thank you, sir. Next question. If income is from an IT services company registered in free zone, offering services to customers in the UAE and outside UAE, maybe to comment on taxability.
Yeah, so again, what will be constituted as qualifying free zone income? So if they render service to overseas companies, it might, I'm saying it might be considered as free zone income, qualifying income, and maybe liable to 0%. But again, we have to wait and see till we get clarification on free qualifying income. Mainland, of course, will be taxable at whatever service they render in mainland will be taxable for sure.
Thank you, sir. Our company financial year is starting from Jan to December. So will we prepare our records to maintain from 1st Jan 23 till 7 years?
Yeah, so your first tax period will be from 1st January 24 because your financial year is Jan to December. So obviously you have to maintain records for 7 years from the first tax period, but always it is beneficial to have past records also. with you. So you should have past performance for at least 2 to 3 years, which is also advisable.
Thank you, sir. Next question. Please clarify if zero-rated sales will be part of exempt income.
You can't consider zero-rated and exempt because see, zero-rated is a concept in VAT law. And where it is export of services, goods, or services, it could be zero-rated subject to fulfillment of condition. But that necessarily may or may not be considered as qualifying income, which could be, taxed at 0% corporate tax rate. So, both are different concepts. You can't merge it or club it and take a tax position based on that. And again, same thing, we have to wait for the definition of qualifying income to determine what will constitute qualifying income and which will get benefit of 0% corporate tax.
Okay, sir. Is UAE pass required in the registration process? Also, is UAE pass applicable to companies?
So for registration, UAE pass is not required. Registration you can do through your MRO tax portal, which existing VAT portal you are using for VAT. From that only you can do the corporate tax registration.
Thank you, sir. For tax group, is consolidation of financial accounts mandatory?
Tax group, of course, you will have to do filing. If you are registered as a tax group, you will have to do filing of the return as a tax group. So one consolidated file will need to be submitted. And obviously, as a supporting, you will have to provide the consolidated financials. So that would be required. You maintain individually for all companies and then consolidate it.
Thank you, sir. Next question. Is any tax audit to be conducted?
Not specified yet, but I'm sure, to claim qualifying free zone benefit, audit financials would be required. For others, not really sure whether at the time of filing it would be mandatory or not. But having said that, eventually at the time when assessment happens, which could be 1 year down the line or 7 years down the line, we don't know when it will happen for your company. At that point in time, we have seen when VAT assessment also happens, they generally ask for the audit report to make sure that the revenue, what is reported, is matching as per the financial statements and matching with the VAT returns filed. Similarly, I believe when the assessment happens, audit report will form the base for the authority to start their assessment. So at that point, you will require. So it is always better that rather than waiting for 7, 5, 6, 7 years when it is necessary, get the audit done. When the financial year ends, keep it in your record with all the relevant supporting documents so that when the assessment comes, you don't have to start scrambling for and looking for information and documents and collating and compiling it. You are ready for the assessment.
Thank you so much, sir. I think that brings us to the end of the Q&A session.
There are some raised hands, Jyotika. So I think we can, the first one is Ms. Ria. If you wish to ask question, you can unmute yourself and there is another gentleman, Mr. Shubham Goyal, also it's a raise hand. So if you wish to ask question, please unmute yourself. You can unmute yourself and ask question.
Am I audible to you, Mr.
Yes,
Kothari,
yes,
now?
you are.
Thank you. Thank you for hosting this session. It's really knowledgeable, first of all. And I will follow back on my questions that I raised on the CapEx expenditure and the depreciation thing. Now, there are certain companies who are into habits of, currently expensing of their laptops and mobile phones. How do you think it is going to be, reviewed by the UAE authorities? Like they might be thinking that there should be some depreciation coming up. So will such expenses which we are deducting right now can be used as a disallowance by the UAE authorities? Because this is something of a concern for me right now.
See, generally, in practice, if you see, mobile phone and laptops generally are replaced every year or two, more probably so, because of the change in technology and the speed and all that. And that's why generally many companies consider that as the useful life of assets. So if you can justify the reason for writing it off in year one itself, and if you have a policy whereby generally on an average you replace it annual basis, then you can claim it as a deductible. I don't see then that as a challenge. But having said that, if you cannot prove and you say that I'm claiming it as a depreciation in year one, but then I'm replacing only after 3 or 4 year period, then that would be a challenge, because then your useful life is 3 years, but you are writing off in year one. So it would depend on company to company and their policy of replacements and their past experience with such replacements.
Thank you. Thank you. That answers my question. Thank you.
Thank you. Okay, I think Miss Ria is not there probably. So I think we can go ahead. I don't think there are any further questions. So I think we can go with the closing of the session, Jyotika.
Thank you, sir. So that brings us to the end of yet another informative session. Thank you, speakers, for taking the time and effort. Thank you, all the participants, for joining us today. Hope the session was informative for you. If you're still left with any more questions, you can always reach out to us. Thank you.
Thank you, everyone, for joining in today. And it will be a pleasure to connect one-to-one with any of you if you have further questions or queries. And you can drop in an email to us, the details of which we'll post in the Q&A. So, you can, I think in the chat, is there an option to post, or it is available, I think, in our registration details and flyer also. So you can send in an email to us, and I can just share the slide, the last slide of our presentation, which has the details of our contact details. So you can just note it down. So these are our email IDs and contact details. So reach out, do feel free to reach out to any one of us, either myself or Prasad or Kapil, and we'll be glad to help you out with any of your queries. And also we'll be glad to take up the impact assessment as well as implementation support, should you wish to take our services. Thank you so much. I'll just keep this slide for a few seconds, and then we'll close the session and we'll end the webinar. Thank you.